Hello everyone, this is Abhijit Chatterjee and Rohan Singh recording our Chartsarefun weekly session, week of July 29th. Today is after market close August 2nd. Boy, was it a rocky week. The market was quite sanguine that Federal Reserve FOMC chief Jay Powell would indicate a interest rate cut. Market wasn't quite expecting it to come in July, but definitely a signal for September. Well, he didn't quite do that. We'll talk a little bit about his statement where he did give some indications, but did not make any clear indication of a cut. And in terms of what happened in the job market, an extremely rocky number. Unemployment shot up from 4.1 to 4.3. The jobs reported was a lot lower than the 175,000 that was expected. Market is now actually expecting, perhaps, and this is a clear indication of what the treasuries did. The treasury yields tanked. Market is now expecting a very good chance of a 50 basis point hike cut in September. So if any, this may end up being actually a buying opportunity. Tom Lee has been talking about small caps being the beneficiary of these rate cut, them outperforming. And while small caps did outperform at the beginning of the week, as soon as Jay Powell came in on Wednesday and did not quite give the indication of the cut, small caps didn't like it, they sold off. So yes, we did get a deep sell-off. VIX shot up to 28. So let's just look to the charts, see what the patterns are. I'm expecting a near-term bounce. I'm expecting kind of a bit of a oversold bounce, and we'll see how far the bounce goes. But in terms of some key indicators, looks like we might be setting up for a bounce for the next few weeks, and the market may start anticipating this 50 basis point cut. And we know that there's always the Jackson Hole meeting that happens in August. So you got to wait and watch and see what Powell and company do at Jackson Hole. Powell in particular gives a speech at Jackson Hole. It'll be interesting the signals that he gives, knowing now that he was quite wrong in not having done the 25 basis point cut in July. There were many that were looking for a 25 basis, especially Jeffrey Gundlach, a very well-known Wall Street columnist, and he manages his own double line capital investment firm as well, made a strong statement that he had hoped that Powell would have at least started off with a 25 basis point cut. We had seen the economy weakening, and so with that, let's just talk about a little bit of the macroeconomics, the jobs data. Let's talk about the 10-year Treasury yield. How did it perform? TLT shot up because that's 20-year yield ETF, and it shot up as soon as the TNX yield came down. So money was big time safe haven chasing today, moving into treasuries, into TLT. Look at the breakdowns in the XLK, the technology ETF, the sector ETF. We look at QQQ. Then we'll look at small caps, IWM, which had been doing quite well, as I said, till Wednesday. There was, of course, some key earnings, and we'll look at Qualcomm that got hit bad. However, Meta target. Both QQQ and XLK met a target as well. We'll look at that. Turns out Amazon also met its target, badly crashed today after earnings yesterday. And let's just go to the charts and look to the patterns. So as always, we start off with our blog site, our Substack blog site, chartsarefun.substack.com. We do publish daily blogs. Do check them out. I appreciate if you just subscribe to it. It's free. Just put in your email and then you'll get notified as soon as the blog gets published. We typically try to put it out in the morning. Also, our YouTube site, the channel is called Chartsarefun. If you could subscribe to the channel and then hit the like button if you like the videos. We do publish weekly videos, and they've got a lot of cool insights. Hopefully, it'll help you kind of make your investment decisions. This is the statement I wanted to start with today. This is the statement that was issued by FOMC, and what you have marked in red are the changes from last month's statement. So some of the key things to be noted here is that while in the previous month he had said that the job gains have remained strong, he cut out the remain strong and have started talking moderated, which means he's begun to realize that job market is beginning to cool down. And then he had talked about the unemployment rate has remained low. That has been cut out now, and made a statement that there is a bit of a pivot. It moved up, but remains low. So expecting that the unemployment rate is now becoming a concern. It has started creeping higher. And of course, this was before the data came out today, which is the July data. Unemployment rate has actually crept up from 4.1 to 4.3, and that's a pretty steep climb from a span of 3.6% last year. So in about little more than a year, from 3.6, we've come up all the way to 4.3. So this is not something that the Fed is very happy with, and something is a concern looking down into the economy weakening. Another key thing that was kind of a signal that Powell gave to the market was he'd said that the economic outlook is uncertain and the committee is highly attentive on inflation. He has now changed it to the dual mandate. So inflation, he realizes, has been moving in the right trending direction. As he said here, there's been further progress towards the 2% objective. However, he's now talking about the dual mandate, which is really price stability, which is related to inflation, and full employment. And now he has put that in because if employment data is weak next 2 months, because the FOMC decision in September is till mid-September, so it'll be a data that came out today for July, and the data first week of right around the Labor Week for the month of August, coming out in first week of September. If both the data are weak, this unemployment for 4.3, if God forsake, goes up to 4.5, Fed will actually have no other option but do a 50 basis point cut. They are a bit worried about the economy getting hit finally. It's taken some time for the economy. It's been resilient and strong, but well, you can only expect consumer to hold up so long with such high interest rates. And this turned out to be a bit of a dampener to the market. Market didn't like it. So what happened with unemployment data? And this is, by the way, a very funny picture of Powell. I don't know if it's AI generated or something that someone caught while he was at the Congress, but ouch, it is a big ouch. The non-farm payrolls turned out to be only 114,000 jobs in July, was the 175,000 expected. And as we said, the unemployment rate has shot up. Tom Lee put out a very interesting remark yesterday that, the outlook has suddenly become very bearish yesterday. And fundamentally, not a lot has changed other than the fact that now, if you look at what the economic data is telling us, it forces the Fed to, instead of doing a 25 basis point cut, now the chances of a 50 basis point cut looks a lot more likely. And that probability from on the July 31st, on Wednesday, when Powell had indicated, that he was holding off for this month, from 14.4 shot up to 29.9 on Thursday. And I don't have the number for today, but must have shot up even higher if you go back and look at the FOMC, projected probability on the rates after the job data today. So a 50 basis point cut is what Tom's expecting, and Tom Lee, and you can expect that the market will love that. In terms of small caps, will love that, and he remains bullish on small caps. He's called it the summer of small caps, and there's a possibility that that could take the small caps back higher again. That said, another interesting thing, and this was Tom Bowley, the other Tom that I follow in Stock Charts, columnist. He has his own website and his own service called earningsbeats.com. Interesting analysis that he shared, and this is the unemployment rate over the last 25 years. We noticed that every time the unemployment rate starts creeping higher, so this happened in the 2000 timeframe to 2000 to 2003, from somewhere around the 3.5 level to 6.3, market came lower. So market does not like unemployment creeping higher, because what does it say? There are fewer jobs out there for people to be fully employed, and that means the economy is slowing and it has an impact on the economy. So that's where we noticed the S&P 500 here came down as the unemployment crept higher. The same happened in the 2007. That, of course, was a financial collapse. Same thing, S&P, we know, tanked quite a bit during that time, and unemployment rate from 4% went up to 10%, a very big sharp climb. The worst thing happened during the pandemic, where from below 3% or around the 3.5%, unemployment shot up to 14.8. Of course, very transient, because that's when people sat at home, could not go to work. Many of the jobs were basically just not there because of pandemic shutdown, and people were not at their jobs. So the unemployment shot up, but very rapidly came back down. So that's kind of a bit of a misnomer, but there again, S&P did come down sharply, as we knew. Now, what Tom's talking about is from a 3.4%, which is as recent as last year, around April of 2023, we've come up quite a bit. We have come up from 3.4 to 4.3, yet market remains strong. What gives? Tom's question is, perhaps we see a bit of a pullback in the market as we have seen in the past when unemployment shoots up. So if this trend continues higher and maybe it goes towards the 5%, you can expect a deeper correction. However, if Fed comes in with a 50 basis point hike in September and tries to curb this job market cooling down and impacted from the economy slowdown, maybe we may not turn out to be such a bad outcome this time. But this is a concern. Unemployment having gone from 3.4 to 4.3, market is climbing higher. A bit of a misnomer from what has happened in the past, where market has come down every time unemployment has gone up. So something to look. We might get a pullback. Tom's Bowley is expecting a pullback to retest the April lows, so which is also a pullback to the 50-week moving average of the indices, and that's a possibility. And that could mean that there could be a bit of a correction coming up this summer as the market gets concerned about the economy slowing down. Also, another thing to look at is the Fed funds rate on the top, followed by the rate of change. This is the year-over-year inflation outlook, and this is the core CPI. So it's the dollar CCPI in the stock charts. By the way, the stock charts does have some of the macroeconomic data for those that use stock chart service. So this one is the dollar unemployment rate, and this is the dollar core CPI or CCPI. So here we notice we marked from where interest rate cuts have ensued. So back from late 2000, we see that as interest rates were cut, what happened to the market? Well, the market did keep coming down. So it's not that as soon as cuts come in, the market just likes it and starts going higher. Part of it is, why are the cuts coming in? Well, the cuts are coming in because of the slowing economy, because the economic conditions not doing so well. So the market, as a result, does sometimes take direction, keeps coming down with the rates coming down. That said, inflation did come down in the 2000 timeframe, 2000 to 2003 timeframe, and this is where the core consumer inflation, as you see, came down almost closer towards the 1% from somewhere near the 3% or so level. Same thing in the 2007, that was the financial collapse. After, this was before the collapse, somewhere around summer of 2007 was when rates was started to cut. Here again, the market did come down quite a bit, as we know, in the financial collapse, and inflation did come down with it. This is more a misnomer, as we talked about in the pandemic situation. Yes, the Fed funds rate started cuts before the it was more around mid of 2019, before the pandemic hit around March of 2020. But then during the pandemic, there was a very sharp interest rate cut, almost close to 0%, 0.25. And as that cut came in, of course, the market did tank, but then start taking off because this liquidity that came in from this cut helped the market, and it went off on a massive rise. But with the market's rise came a massive rise of inflation from below 2% from somewhere around 1.5%, shot up to over 6.5%, 7% core consumer inflation year over year. Since then, we've seen that there's a steady decline of inflation, but so far, Federal Reserve hasn't acted on it yet. They're still watching. They're concerned about this very sharp climb. They're concerned if this is transient and perhaps will resume its climb again. But so far, we have to watch now as the inflation cools down. We still have another inflation coming up in the next couple of weeks for the month of July, and then there'll be another one before the Fed has their FOMC meeting in mid-September. So we'll get 2 months of inflation, 2 months of jobs before FOMC meets. And if we see further cooling down of the 3.28 going below the 3 handle, likely in the next couple of prints, we can expect to start seeing cuts shape up, and we may even get to 2 or 3 cuts. Depends on where the Fed sees the economy headed and how they have to act on top of that. One key indicator we do want to talk about is Treasuries actually did what the Fed would have done. Market was expecting some form of an accommodation from the Fed in terms of rate cuts. Well, the Treasuries did that for the market. Guess how much we got? We got close to 40 basis points. So from somewhere near 4.2%, we can see 4.18 or 4.2, it closed near 3.8. So 40 basis point movement in treasuries in a span of a week. And that's the 10-year treasury, but you can look at the 5, you can look at the 2-year yields. All of them took 35 to 40 basis points of drop this week. And that means that the treasuries, and this is a long-term trend line of the TNX from higher lows from 25.25, 32.95, 37.85. So where did we come and test? We came and tested that drop of treasuries from a sharp 5% to 3.78 in the late December. Why did that sharp drop come in? Late December, during the FOMC meeting, Fed pivoted and started talking about having done with their rate increases and started talking about even up to 3 to 4 cuts for the year. And when they did that, it took a very sharp drop in treasury yields all the way to 3.78. So we're now very close to that. So there is some key support here in 3.78. We tested 3.79. So something for us to watch. But if you pan this out as a head and shoulder pattern with a left shoulder on a slanted neckline, of course, left shoulder here from 25.25 to 43, right shoulder from 32.9 to 49.97, or almost 5%, back to 3.78, and then 47.37. If this breakdown pans out, we're talking about a 2.6% 10-year yield. That's a significant drop. Not sure if that will really happen. This could really mean safe haven buying. It could mean economic slowdown. It could mean treasuries really becoming way too concerned about the economic slowdown. It would mean many interest rate cuts. Now, not sure. You never know. There could be macroeconomic factors. We know there's a lot of geopolitical tension. Pray not of any third world war. There's a presidential election that could have an outcome on how the economy is headed in US, and there are presidential elections in other economies around the world as well. So a lot of unknowns, no question about it. But pray this doesn't happen, because this happens, it may not be so good for stocks, because that would really mean bad economic condition could take 10-year yield down towards that 2.6% from currently near 3.8, 3.79. Now, a beneficiary of the 10-year yield coming down, the TLT is not 10-year, it's 20-year treasury, but it took off. It broke outside out of an inverse head and shoulder. We see this left shoulder pull back from somewhere around 94.8 is the neckline, 94.5, 94.8, pull back to 90.2, form the left shoulder, back to 94.8, pull back to 86, back to 94.2, form the head, and then a pullback from 94.2 to 89.5, slightly below the 90.2, but left shoulder, right shoulder around the 89-90 level, head around 86. So take 86 to 94, 8 points. Add 8 points to 94, 102. That's where we headed on TLT, and today we came pretty close. 3% jump in TLT today in a single day, up $3, close up to 98. We got 4 more points to head to the 102. So that was something that in many ways indicated, and with very sharp volume the last couple of days, indicating the market is now beginning to get a bit nervous about stocks and trying to diversify and get more into safe haven buying of treasuries. And TLT is the largest way to invest in treasuries, like a stock, like buying an ETF. Something very interesting happened, which gives us an indication that we might have kind of hit the fear gauge very rapidly. And very rapid fear gauge climbs often indicates some form of a capitulation bottom, and we could be headed for somewhat of a reversal. Why? Look at what happened the last time in the 2023 timeframe. We got 3 successive peaks in VIX, 1708, 18.88, 23. You can draw a trend line through it. Failed exactly at the top of the trend line and then came back lower. Look at what happened this year. 3 successive peaks of the VIX, 17.9, 21.3 was the April low. This week, today, we hit 29.66. Very close to 30, exactly at the trend line, and pull back. We didn't close at the highs, which we've been bearish for next week. We pulled back from it and closed near the 23. So this kind of a reversal, kind of a candle on VIX, where we leave a long tail. You notice whenever those reversals happen, are towards to where the VIX turns back lower from there. Indicates that there's a good chance the VIX may start trending lower, and we may start getting a bit of a market moving higher in the next several weeks. Now, the thing that we do want to watch about is small caps. We know that Tom Lee has been perma-bullish, extremely bullish of small caps. He did talk about 40% climb in small caps this summer. Well, one of the indicators of where small caps were showing a bit of a red flag was on Wednesday. Wednesday was when Jay Powell came in. Before Jay Powell came in, folks were very bullish in small caps, expecting him to be a bit dovish, indicate a clear indication of September cut, and it would have perhaps broken out. But Powell, disappointed, did not do that. And as a result, we formed kind of a bearish reversal candle right here, closed where it opened, right in the 224 level, and left a very long bearish tail on the top. That kind of a tail at the trend line there, and with the very next day on Thursday and then Friday, two back-to-back days, heavy volume and a breakdown from a key level at 215. So 215 to 28 is 13 points. Subtract 13 from 215, you get a 202. So we think that's where IWM is headed. That will help close out the gap that it left from like when the negative print on CPI came in early July 11th or so. So that gap will get closed near 203.5 at the 202 level and could then perhaps resume its climb with a higher low. So we've seen IWM has been climbing higher lows, 186, 190. And we could get a higher low at 202 and then from there resume a climb. So if those looking to play the small cap move, perhaps with the 50 basis point cut in September, will absolutely help small caps have a very strong finish for the year, may want to just wait for that little more of a pullback. Today it closed near 209. If we get lucky for a couple of, sometimes the market does not just go up in one shot, it may have another pullback next week. If that does come in, the close of the gap and pullback to 202, the target for this breakdown, may be a great point to start taking a position in small cap. One key indicator that was shared in risk reversal by Mark Newton, who's the chief technician of risk reversal with Tom Lee's company, is this ratio of the technology. This is the EQ-weighted technology RSPT to EQ-weighted S&P 500 RSP. Take that ratio, and we can see it's been climbing up uptrending channel, which means technology has been leading the S&P 500. That's the upper end of the channel, and it failed exactly touching that top of the channel at 0.2286. But look at how when these pullbacks come, we know about the idea of the market going up an escalator and coming down an elevator. This is a great example. It gradually goes up over several weeks, touches the top of the trend line, and when it drops very sharply. So here, a span of 3 weeks from the top of the trend line to the bottom of the trend line. Here, a span of 3 weeks, 3 candles, each candle is a week from top of the trend line to the bottom of the trend line. That kind of a sharp drop from the top of the trend line to the bottom of the trend line, finding support there, not closing below it, but rebounding and closing slightly above it, is another indication that the market capitulated likely at a bottom this week, and a good opportunity for technology stocks to start getting a bid again into the next few weeks. So this indicates a bullish reversal for technology, having come from the top of the channel to the bottom of the channel, with many attractive values. So let's look at the king of technology ETF, QQQ. This is the Nasdaq-100 ETF. We had shared this last week, a classic head and shoulder pattern. The neckline was right around 473. Head was at 503. So that's 30 points. Subtract 30 from 473, that's 443. That's what we had drawn as our head and shoulder target. Guess where the QQQ's level was today, the lows, 444. So that's, and it's a beautiful number, 444, all triple four, in fact, quadruple four, 444.47. Love magical numbers. Love the fact that it also bounced successfully off the climbing 150-day moving average. In the last pullback in April, same thing. It didn't come as low as the 50-day, 150-day, but kind of came near that level and rebounded from it. Today, 444.76 is the 150. We just briefly crossed below it at 444.47, but closed a lot above it near 448.75. So this was a successful test of the climbing 150-day moving average. It met its head and shoulder target. We could be headed for a reversal. And if any lower low in price, RSI is not at a lower low. RSI is maintaining above 30 at 35, slightly higher than the low that it came in around the 23rd or 24th of July, which is towards late last week. So bit of a positive divergence in a higher low in RSI, lower low in price, having met the head and shoulder breakdown at 443. We could be, and a successful test of the 150, which is climbing, we could be headed higher again. Now, what about the ETF, the sector spider ETF for technology called XLK? Same pattern. When it breakdown happened, the left shoulder to the head, negative divergence in RSI, Classic head and shoulder from 220 to 238, that's 18 points. Subtract 18 from 220, 202. That was our target, 202. Exactly met it, cut below it, 201.25, and closed with a bullish doji candle, right? You can see that it left a long tail on the bottom, closed where it opened, and this is a bullish reversal candle. So if any, we could be a bit of a hammer candle, not fully a hammer because there's a slight wick on the top, but a bullish doji for sure, and a reversal that could take us back higher for the next several weeks. So XLK, QQQ both seem, having met their targets, both seem to have successfully, tested their 150 day moving averages. Here we didn't draw the 150, this was the 20 and the 50. So here we do have a bit of a bearish cross of the 20 going below the 50, but the 50 is kind of flattening out. It's possible that we may not go and take out new highs on XLK. I'm not saying that. We may start getting a bit of a reversal and then maybe the next pullback down. So something to look at, but near term, conditions are ripe for a reversal. Same thing, RSI didn't go and close below 30, not like a deeply oversold, like not an RSI that's going lower lows. It's an RSI that's a slightly higher low from the previous low in price. So that's also a bit of a positive divergence in RSI. Let's look at two key or three key stocks in the technology sector. Start off with NVDA. Beautiful positive divergence in NVIDIA. Yes, broke down below a key level at 118. This measured by the 118 to 140, that's roughly 22 points. 22 points from 118 is 98. There is a gap near 96. So eventually NVIDIA might just close that gap near 96. But for today, a lower low in price touched 101, but higher low in RSI, positive divergence. As far as this pattern maintains, this is bullish. This is possible that we might start getting a bid on NVIDIA and it may start going higher. But it may not be able to go seek higher highs. If any, we have a bearish cross of the 20-day below the 50-day. The 20-day is now going to start declining. That's right now at 116. So that's going to act as resistance. We noticed that when NVIDIA had previously touched 106, it failed at that, at the cut of the 20 and the 50-day, and then it pulled back. So now the 20-day is going to start coming lower over the next several days. We might now act that as a resistance, fail there, and then pull back and likely come down towards the 96 level. However, if we are saying that this is potentially a head and shoulder forming with a neckline at 106 now, 106 with 115, back to 106, going to 140, back to 106, we now going to break below, and this becomes a head and shoulder of 106 to 140. That's close to 34 points or 35 points, because 106.9 is 107 literally. That 35 from 107, you're talking about closer to almost 72 or so. So this could be very bearish for NVIDIA if that happens. So far, let's just see how price action is. I see a positive divergence. I'm not as concerned. I feel there's a good chance we will definitely try to rally back and see if it can take out the 20 and the 50-day and start breaking above 120. 120 is a key level of resistance now. What used to be support in the past is now going to be a key level of resistance. It failed this week, climbed from 106 to 120, failed. So this 120 is what NVIDIA has to take out for it to resume its bullish trend. Qualcomm had a descending triangle breakdown. We had talked about it. So here also a bearish cross of the 20 below the 50. The descending triangles from 193 to 230, that's 37 points. Subtract that from 180, that's 157. Target was 157.05. It came very close to that, 157.53. Also a bit of a positive divergence, lower low in price. RSI did not cut below 30 at 33. And we might, and also a bit of a doji reversal candle today. We might have basically put a near-term bottom on Qualcomm as well, and it could start its fundamentals as strong as ever. They have very strong AI PCs rolling out with 11 different PC manufacturers, Lenovo, HP, Microsoft, many of the PC manufacturers will have the AI PC coming out, and they also will be rolling out their chips in the next generation smartphones, AI-powered smartphones with Apple and Samsung. So they remain very dominant, and of course, they're heavily in the EV space, heavily in the IoT space. So the business is strong as ever. So it could just mean a strong buying opportunity in Qualcomm, an extremely strong buying opportunity, and it could start resuming its climb from here. Finally, Amazon, the king of the cloud, they had their earnings yesterday, a head and shoulder breakdown again from 201 to 180. That's roughly 21 points. Subtract 20 from 180, that's 159. So that's the target. Came very close to that, 160.55 in the drop today, but beautiful reversal. Left a long tail, heavy volume, so there was buying. Otherwise, if the buying had not happened, it would have closed at the lows of the day. It did not. It intraday touched 160.55, closed a lot higher near where it opened. In fact, above where it opened. It opened near 166.75. It closed above that at 167.19 towards the highs of the day at 168. So 168.7 was the high of the day, closed at 167.9, indicates bullish buying, bullish accumulation on Amazon. So this could have been a strong buying opportunity. We could have maybe at the 165, 166 level is where you could see a neckline to 189, 166, 201. We could be potentially moving back up towards the 189 level to test it again. That's closer to where the 50-day moving average is, near 187. And then from a right shoulder, and then if the economy really gets bad, goes downhill, then maybe it could just break down from there. With that, we remain bullish. To sum it up, we feel that the market is capitulated, no question about it. VIX shot up, hit the top of the trend line, reversed from that high and closed below it, indicating that there's a good chance that we might have put in a low in the markets today. The key head and shoulder breakdowns on QQQ and XLK were met. The technology to the S&P 500, equal cap ratio touched the low of the trend line, closed above it. We could have bottomed in technology today as well. And finally, the small caps are very close to meeting their target near 2.2, closes the gap. And if we do get that 50 basis points rate cut in September, as Tom Lee, as the market's probability has gone up, it's not just Tom Lee, the market is not expecting, especially this slowing economic data, then small caps could be racing towards a nice outperformance for the summer into the rest of the year. With that, good luck trading. We'll talk to you next week.